I want to talk about the important question is, do FIAs or fixed indexed annuities still have a place in a high interest rate environment? And my answer to that is simply absolutely. I mean, there's a hard thing to get past people when they say, well, we got a MIGA rate, 5-year MIGA rate of, whatever it is, 5.5, 5.6, whatever it is at the time. Why would I ever put anybody into an FIA versus a MIGA? And it's real simple. I mean, and I know you're going to have questions for this. And I know you and I have actually had some pretty good discussions about this because you're like, well, if I can get a 6% interest rate for 10 years, why wouldn't I just do that? I guess it all comes down to a couple things. Number one, what is the fixed 1-year fixed rate on the FIA? What is the rate integrity of the company? And what is the historical returns if you halved the participation rates? That's really what I look at when I'm not looking at the, crazy participation rates that are going on right now. I'm like, what would have they been if we had 60% of the participation rate? Would have it still done well? Would have it performed? And most of the companies I use, I would say it will. And then also the thing I look at with MIGAs is because 90% of my clients are income riders, the MIGA doesn't meet the need.
Right.
So, yeah,
Yeah, that's good.
that's
Well,
my
and
thought.
I like it. A good FIA going to average, and when I say a good FIA, I'm not talking about a good index strategy, a single index strategy in a product from a carrier that has poor rate integrity. I'm talking about a mixture of index strategies with collectively good rates from an insurance company that's financially stable, has good customer service, good rate integrity. I'm talking about a well-rounded product. A good FIA is going to average somewhere between 5 and 7% over the long term of the policy, right? I've talked with carriers about this reality. I've talked with index providers about this reality. That is a reasonable expectation for an indexed annuity, a good indexed annuity over the long term. We have MIGAs right now that are between 5 and 6% guaranteed from anywhere from 3 to 10 years, right? Guaranteed. So I
Which we also
see,
have to look at what's the withdrawal rate on that though, because the ones that
sure.
have the highest only allow interest only withdrawals or no withdrawals.
Correct. Correct. And then you check the death benefit as well. Make sure it's actually the full account value at death. Make sure they're not charging you some buy up. A lot of times what they'll do is carriers will have a high rate and then they'll have reduced benefits. And if you want these important benefits, you have to reduce the rate. And by the time you reduce the rate, it's lower than what other products are offering
Correct.
with those features already
Correct.
embedded. So make
Sounds
sure you
like you know
know the
what you're doing
product.
here, Caleb.
I've seen the song and dance a time or two. It's been
Yeah,
it's been like
so
this for a
much
little while.
for sure.
Um, but anyhow, this is really the challenge that we're up against is the MIGAs are paying really, really high and guaranteed, and indexed annuities are going to average what they're expected to average over the long term, that 5 to 7%, and they're not far off of each other. So when you're looking at the two from an accumulation perspective, I think there's a couple of considerations you need to ask. Number one, what's going to happen at the end of the MIGA guarantee period? If you go and you sell a 3-year MIGA, then what? A 5-year MIGA, then what? A 10-year MIGA, then what? Right? Probably, well, and I say a 10, but 7. Probably you're going to end up in either another MIGA in the end of that period, or they're going to go into CDs, or they're going to liquidate to the bank, or they're going to go into an FIA. And so the question becomes, what is the future? In an FIA, you've sure, like the renewal rate integrity should be better during the surrender period, and then a lot of times even with good carriers after the surrender period the renewals may not be quite as strong, but it's liquid money at that point versus you buy a 5-year MIGA and then a 10-year FIA and you've got illiquid money for 15 years instead of 10. So you elongate the surrender period by stacking those different types of products on top of each other. I'm looking at it from the standpoint of where do FIAs actually fit into this high rate environment? And obviously, number one is if income's needed. You've pretty much got two options there. If we're talking about guaranteed income, you can either annuitize or you can use an income rider. We know that annuitization is not typically in the client's best interest because they lose control of the money and they lose interest crediting. I guess there's technically an internal rate of return based on the excessive amount of income that they can receive versus the premium they pay into it. Great. We can argue that all day long, but they lose control nonetheless. Second one I was thinking about, I was like, well, shoot, if for some reason a bonus is needed, if they're trying to do a replacement or something like that, realistically, MIGA rates, there's a lot of scenarios where even the high MIGA rates right now are not going to justify a replacement. And then anytime you're dealing with long-term planning, right? When you're actually dealing with, we're trying to strategize this for a longer period of time. Like you mentioned, Chad, you've got 1 year fixed rates between 5 and 8%. And then the question, plus good index rates, right? Caps, high pars, low spreads. Then the question becomes all about renewals. But those are kind of the
That's
three
actually
areas.
that's my biggest concern is that last one you talked about, longevity planning. I focus on longevity planning, and a 3 or 5 year MIGA has nothing to do with longevity in my books. And when I say 90% of my clients are income riders, it is true. 80% of my business is income riders because, this year alone, it's actually probably a little bit higher of a percentage. I've written quite a few in MIGAs this year. I've probably written about 3 million or so in MIGAs. And so this year has been the exception, but it was almost always, I ran into, and I'd never done this in a long time, or I can't say never. I had 2 clients over 90 years old, and they had plenty of money sitting on the side. And then they go, why do I got all this money sitting on the side in a bank doing nothing when I could get 5% or 5.5%? And so, everybody knows the commission on those things is virtually nothing, but what it did for my clients was huge. And the pain in the butt it was trying to get those issued because they're always with companies that just take forever. Both of them took over 3 months to get issued. And it was just insane. But you say, well, was it worth the time and effort? Yes, because it wasn't about me and what I wanted. It was about what was best for the client. But in that scenario, we have to look at longevity planning means you are generally geared towards using longer solutions to the problem. And once again, we go to that question that nobody knows, the 2 questions nobody knows: how long are you going to live for, and where's the stock market going to be tomorrow, let alone 5 or 10 years from now? A
Right.
MIGA cannot answer that question.
Right. Totally. I made a note, things to consider: purpose of the money and renewal rate integrity, right? So, number one, what's the purpose of the money? Is this a plan for living or is this a plan for dying? Somebody that comes to you and they say this is a plan for living. Okay, what we're looking at is something that maybe not even now, but at some point is going to be used for income. The question is, what's the time horizon there? If somebody's going to kick this down the road 5 years before they start deferring income, a lot of agents would make an argument for, well, let me go get them 5.5% guaranteed for 5 years. Then at the end of that 5 year period, we'll roll them into an FIA at the time. Problem is, number one, we don't know what FIAs at the time are going to be. So
We don't
we
know
can't
what
create
FIAs, we don't know what income riders, we don't know what fees,
right.
we don't know any of that.
We don't know any of
We
that. So
don't know
you
if they're
can't,
still going to be available.
correct.
There was a time in our industry where they were talking about having to totally adjust income riders because of some rules and laws that were coming around. And so we have to think about what is the best thing we can get a client into, despite our people's need or want for future business. What is going to be the best for the client?
Yeah. The other thing that I would make an argument toward is that even at our high MIGA interest rates right now, they still pale in comparison to a ton of roll-up rates. Whether it's a roll-up rate that has just a nice minimum, but it's stacked, or a roll-up rate that isn't stacked but it's a high guarantee, they're smoking MIGA rates. So you got to understand that if we're looking at a point, even 5, 10 years, whatever, that we're talking about, it's eventually going to be used for income, you almost always end up with a greater benefit base, which equates to typically more income, depending on the payout factor applied to it, than you would if you just use a 5 year MIGA, then put them into an income product, and then they maybe or maybe don't get any kind of real crediting toward that benefit base. They may start with a higher account value, which could go to help death benefit in the long term. But yeah, as far as the income side goes, if it's a plan for living, you'd be hard pressed to use a MIGA, even for a short term deferral of that income, and actually have them be money ahead in the future. Just like if you're looking at an accumulation play, when you've got there's a product out there that's 6% guaranteed for 10 years, compounded. It's like, that's a tough scenario to try and make an argument about an FIA in contrast for accumulation, I think.
Yeah, but
Um,
remember too, we have to think about this. I've heard some agents give me a hard time because I do income riders and so many of my clients' uh, policies. And once again, we have to look at the logic behind about it. Talk about this all the time. Once I write that income rider, there's no future business for me with that money. It's gone.
mhm,
So if I was truly looking out what's best for me, then why would I ever do that? Number two, a living plan. Catch what I'm saying. I'm not saying income. I'm saying a living plan. Is a plan for living or a plan for dying? So living could be a vacation fund. It could be a kid's college fund. It could be a grandkid fund. It could be, it could be a living legacy plan. There's all sorts of reasons why we put income riders. And I'm actually, you guys know we own Retirement Realized Radio, where we help agents become or go on the radio. It's an incredible information opportunity for clients, but it's an incredible lead source as well. And one of the scripts I'm writing is an income rider is not just about income. It's money that you want coming in no matter what, for property taxes, for there's whatever it is. There's so many things you could do or purpose that money for, that an income rider benefits. And I'll hear agents say that all the time. Well, my client doesn't need income. Well, I bet you if I met with them, I bet you they probably would. But what is the purpose? It's a living plan. So find something they need to count on money for the rest of their life that may not even have to do with income, but it has to do with paying for something they want to do.
mhm.
So
Yeah.
that's where MIGA doesn't come into play. And you can't put those type of things on MIGAs.
Yeah, I think right, for any kind of lifetime guarantee, right?
Correct.
The way I would look at a MIGA in the realm of quote unquote income would be essentially a period certain. If you got a 5-year MIGA and you're going to scrape the interest off each year, say you got $100,000 MIGA, let's say ease of number, let's just call it $1 million MIGA. It'll sound nicer. And you get a 5.5% interest rate for 5 years. But you draw 55,000 in income, and then you get your $1 million back. Okay, that's great.
Yeah.
But
And there's
that's
times where that comes into play, and that's
sure.
important.
Absolutely, absolutely. But to your point, that's not a lifetime benefit. So you have to understand what's the
Yeah.
time horizon that we're trying to plan this for. Um,
Correct.
but yeah,
Correct.
so MIGAs versus
Yeah. I
FIAs,
think,
most definitely still a place for
yeah.
FIAs. What were you going to
Yeah.
say, Chad?
And once again, I've been doing this for almost 20 years. We have not seen MIGA rates this. I don't even recall the last time I saw MIGA rates this high, but I also haven't seen the 1-year fixed rate this high either. I haven't seen caps participation rates and spreads as high as they have been. So, well, caps participation rates and then spreads obviously is low. I don't even have hardly any products I use anymore with spreads, but mine's participation rates and caps. But if I can get an S&P capped at 10.5% and with good rate integrity, that's an important thing, because just because somebody has a 14% cap on their S&P doesn't mean next year it's going to be that. And so I think we just need it goes back to everything we talk about all the time. It's the way we ask questions and what our personal beliefs are. And if you think a MIGA is the way to go, then guess what? Every client you meet with is going to be a MIGA. If I think FIAs are the way to go, then every client I'm going to be as a MIGA. I don't think of anything that. I go through the fact finder. I find out what the purpose of the money is. What do they want it to do for them? What do they need it to do for them? We talked about this last week. Well, not what they want, it's what they need. And then we find the best product for that solution.
That's right. That's right.
Yep.
And it could be an
Okay.
FIA, even in a high interest rate environment.
Yeah,
It could be a MIGA.
for sure.
But the point
sure.
is, depending on the purpose of the money, there is still a place for both.
Correct. Okay.
So,
Well, that wraps
awesome.
it up.
That
As
wraps it
always.
up.
As always. Happy selling.
Oh, you're asking me.
You could,
Happy selling.
Yeah, no. Yeah, always happy selling. Okay. Have a good day.